I've
Okay.
joined.
Okay. So we're on this research and development, right? And we said that
Yes.
research costs should always be expense, but development costs could depend. They could be capitalized if they after the point that they have made the criteria for it for recognition.
For
Yes,
recognition.
yes. And actually, we can just proceed with, for example, you have these words. There is a small point here. You can see this, right? Uh, a very nice point. It's just a wake-up call, but it's a fine point. If an item of plant and equipment, presume you have an item of plant, let's say, it was used in the development process. You know the plant depreciates, right?
Yes.
Yes. Let's say that you have a plant specifically used for developing an intangible asset. That plant, let's say it is $10 million worth. Maybe it has a useful life of 10 years, 5 years, I mean. After each year, you would be having a depreciation of how much? Of 2 million, right?
Of 2 million.
2 million,
Yes.
yes. So you'd say, okay, credit the asset by 2 million to reduce it and then debit this amortization. You debit this depreciation to profit or loss as an expense, right?
Yes.
But now, if that item is being used for the development process, it means it is being used to develop another asset. It is yet to be realized. Whatever goes to the income statement means that it has already done its job and it is now realized. That's the point you should get, right?
Okay.
So, if we are using that
Okay.
asset to create another asset, right?
Yes.
This is what we're going to do. Instead of going and taking these two as an expense, you do like what we did with borrowing costs, right? Eligible for capitalization. Instead of taking it to profit or
Okay.
loss, we added borrowing cost to the non-current asset, right? So we are going to do the same here.
Yes.
You take this depreciation and add it to the cost of development. So if the development cost maybe
Okay.
if you had incurred 4 million already, you would have to add the two what? The 2 million.
Two
Right.
million.
Yes, so that's how the
Yes.
double entry would have gone. You would have said, okay, credit my plant, credit my plant by 2 million, and instead of debiting profit or loss uh, with an expense, we say no, you credit the development what? Expenditure by how much? By 2
Expanded
million, yes.
by
Yes,
2.
yes. After having completed the development, you would have accumulated your cost, and then maybe it could be amortized in any way. I hope you know the difference between
Okay.
amortization and depreciation, right? You know the difference?
Um, Not really.
They are just words. For tangible assets, we call it a depreciation. For intangible assets, we call it amortization. It is exactly the
Okay.
same
That's
thing.
what I wanted like to explain. Okay.
Okay, okay, then that's fine. So this is what we should know about what? This issue. Let me take it so that maybe we know, okay, this is
Okay.
what we spoke of, yes. And so going
Okay.
on further, we say, in contrast with the research costs, development costs are incurred at a later stage. I think that's why I told you research costs should always be expensive because it is a very early stage, but development costs are incurred at a later stage, and that's why part of them may be capitalized, but part of them may still go to the income what? Statement, right?
The income
Yes.
statement. Okay.
Maybe you could look at this wording to know how you can a bit distinguish. Look, for example, examples of development what? Cost. The design,
Costs.
construction, and testing of pre-production or pre-use prototypes and models. You have even done the construction and the testing of something. Something is actually visible, right? You actually expect to get
Yes.
something, yes. But also the design of tools, jigs, molds, and dies involving new what? Technology. You see that, okay,
Technology.
you're using new technology, oh, we expect to get something from this. Although this alone won't be the condition to say that you have to capitalize, but it will show that this is development what cost. So much care needs to be done, right? Much care needs to be
Okay.
taken. Okay, then we speak of other internally generated intangible what? Assets,
Assets.
apart from goodwill and maybe research and development, as we have seen. Normally, for our internally generated intangible assets, we normally do not recognize them. Research and development, you also generate it internally, but you can measure the cost because you see it. You do it, you incur the cost, you see it, you can measure it reliably. But for other internally generated intangible assets, we usually do not what? Particularly brands, we usually do not do what? Do not recognize them. Right?
Recognize.
Yes.
Okay.
That's why you say all these all usually fail to meet one or more criteria for what? For recognition. Right?
Okay.
Yes.
Yes.
And so in some cases, they are probably indistinguishable from internally generated what? Goodwill. Some, okay, you cannot even distinguish them from internally generated what? Goodwill. And that's why I told that they can be just
Goodwill.
part of that goodwill. Yes. So
Okay.
apart from the assets you have specifically seen, whenever you have any other asset and you are told it's internally generated, you say that, okay, this one won't be recognized. It shouldn't be recognized in the books.
Okay.
Yes. Cost of an internally generated intangible what?
Assets.
Yes. Intangible assets normally it should be initially measured at cost, just like for PPE, just like you said, right?
By right.
Yes. But
Yes.
subsequently, they can be measured at cost or revalued what? Amount, just like for PPE,
Amount.
cost model or evaluation model, right?
Yes.
So that's just how it should what? It should go. And now the principles underlying this cost may or may not be included are similar to those under non-current assets and inventory. That's why you see it's just the same. Simply speaking, when you do go to the cost, you shouldn't have anything to worry about what to do, right?
Okay.
Yes. So we may now go to recognition or of an expense. We just need to specify that the following costs should always be expenses. You should never think of them as an intangible what? Intangible asset.
Intangible cost.
Yes, yes. This is what we try to explain. So all expenditures related to an intangible asset does not mean the criteria for they do not meet the criteria for what? For recognition, right? Either maybe as an identifiable
Yes.
intangible asset or as a goodwill arising on acquisition should be expensed as what? As incurred. So
Income.
whatever that does not did not meet the criteria which we just saw should always be expensed. For example, let's say you are speaking of these startup costs. They have nothing to do with that asset, right? Startup cost. Let's say it's a training cost. We spoke about this at the very beginning that you have trained an employee and you are saying that you have incurred those costs and that's your intangible asset. No. Training an employee doesn't mean that they would not leave. If they need to leave, they could leave. So you won't have any control of those costs, right? Let's say you have done the advertising costs. Okay, so we are speaking of those other costs which we didn't mention earlier, that they should just be taken as what is expenses, spoke of startup costs, training costs, advertising costs, business relocation costs. Of course, there are obviously things which are not like, like this one it is obvious not an intangible asset, right? Advertising, obvious.
Yes.
Maybe training, if you are not sure of how to control works, then you would have also found it. So it's no big deal. But also these ones too are
Okay.
normal things. Prepaid cost for services, for example, maybe you have prepaid, you need the service, but you have paid for something in advance. Those are usually taken as prepayments, right? For example, let's say advertising or marketing. You have prepaid, you have paid. Maybe you need to pay for advertisement. Maybe you need to pay something, maybe 100 million each year. But maybe you paid for more than 1 year. Maybe you paid for 1 year and a half. You overpaid. You cannot say that is an intangible asset because it's an advertisement. Maybe you cannot touch an advertisement, right? That one is taken as a
Yes.
prepaid expense. So it's also something obvious.
Okay.
Yeah, they just try to differentiate matters here, but it's a normal thing. And then also for
Okay.
subsequent measurement, like I told you, it's just like for a 16 what? PPE. You measure
PPE.
the cost model, you measure it at cost, less accumulated amortization and the accumulated impairment what? Loss. Instead of
Yes.
depreciation, we use amortization for intangible what? Assets. Nothing else.
Assets.
Yes.
Okay.
And for evaluation model, we do the same. We carry the asset at a revalued amount, less subsequent accumulated amortization and subsequent accumulated impairment what? Losses. Just like for
Losses.
the exact like for the revaluation model under what? IAS 16. So even those rules, they don't know the revaluation gain going up, or if the revaluation loss is going down, the principles are exactly the what? The same, right?
Okay.
Yes, maybe you can just go through a little matter like this. Maybe the fair value must be measured reliably. This is obvious. Any fair value should be measured what? Reliably, right? And usually we get the fair
Reliable.
from the market, yes. But for intangible assets, it's not easy to get the fair values right. Just like for what? Just like for tangible
Yes.
assets. For the fair value, you
Assets.
should have a market that is active and a lot of things are being traded, right? Yes. So
Yes.
it will really depend. But the other thing, the entire class of intangible assets of that type must be revalued at the same time to avoid selective revaluations. So the principles are just like for a 16 what? PPE. That's what we say. If you
Yes.
revalue a given
Yes.
asset, the whole class to which that item belongs must be what? Revalued to avoid selective revaluation.
Evaluated.
Yes. That's just the same. But
Okay.
also, if an intangible
Yes.
asset in a class of revalued intangible assets cannot be revalued because there is no active market, you need to revalue it, but unfortunately, you cannot get the fair value, right? What can you do now?
Yes.
In that case, we say the asset should be carried at its cost, less any accumulated amortization and impairment loss. That will be the closest approximation, right?
Okay.
Yes, because you won't
Yes.
have
The
the fair
carrying
value.
amount.
Yes, you won't have the fair value.
Okay.
Yes, so and lastly, I thought the revaluation should be made with such regularity. We spoke of the frequency of revaluation depends on the volatility of the what? Of the asset. And revaluation is usually done and actually applied when actually you see there is a material difference between the what? Between the carrying amount and that fair value, right? Even if there are a lot of
Okay.
changes, but you see the difference is not material, then there is not even the point changing because it will just be the same. You just be wasting the time. And that's why, as I told you before, accounting works on the principle of materiality. Is it material to do that? Because changes would always be there.
Okay.
Okay, now I think we are done with these principles. We are just, like here we are speaking of useful life. For example, on this matter
Mm.
of useful life, it's fine. Maybe if you are actually in the company dealing with that and you are trying to figure out, oh, how should I know the worth of this asset of mine? Right.
Yes.
Hello?
You were on mute.
Yes, yes. Okay. So as for the useful life, as for the useful life, the company tries to figure out, okay, I have this intangible asset. For how long can I use it? Right. Maybe
Yes.
for how long can it last? 5 years, 10 years, infinite years. So there are factors that the company would usually what? Would usually consider in order to come up with that useful life of an intangible asset. For example, among below are the factors that the company could consider. For example, maybe you could consider the usage, right? If you use
Yes.
something so frequently, we will expect it to last less, right? Like we would expect not to last longer
Okay.
because we know that it will be the use will be too much and so it will be easily exhausted. But also the typical product
Okay.
life what? Life cycles. Of course,
Cycle.
it also depends on what you deal with, right? There are products with a short life cycle and there are others with long life cycle. So the shorter the life
Life
cycle, the
cycle.
shorter should also be the useful what? The useful life. But
Life.
maybe the technical, technological, commercial, or other types of what? Obsolescence. If something expects to be obsolete in maybe in the near future, the useful life would also be, we would also have the smaller useful life, right?
Okay.
So these are just
Yes.
the factors that the company would do what? Would consider. All right, another
Okay.
example, let's say the stability of the industry, expected actions by competitors, things like this. If you find that okay, this industry is not very stable, then actually your intangible asset will also have a shorter useful life. Maybe the
Okay.
competitors actually are maybe we have a very, very stiff competition, then we would say, oh, our intangible asset is not going to last long because maybe in two, or
Okay.
maybe in one, in 2, 3 years, actually, I will be undone by our competitors, right? And they will be the market leaders.
Yes.
Yes.
Okay.
And the other point here, we say the level of maintenance expenditure required. So actually, maybe the legal similar limit. Simply speaking, these are just the hints that the company would base on to come up with the reliable useful what life of the
I
company.
see. Oh, that
Yes,
was life.
yes. So it's just that what remains here is just the literature. For example, they're telling you about the computer software and many other intangible assets normally have a short life. Why? Maybe because they are susceptible to technological what? Obsolescence. They are giving examples on these now, right? They are based on these technical
Yes.
technology and technological factors and see that, for example, computer software is obvious, right? Computer is obviously
Yes.
in the field of ICT development. So the changes, we have different programming languages, we have different revolutions. So that's fine. You may have a software today, which you see is fine, but in the near future, it may be obsolete, totally obsolete.
Okay.
Again, we speak of amortization period and amortization method.
Mm.
Amortization period, I think that's what we spoke of the useful life. Maybe amortization method.
Yes.
Normally, we use the straight line. That's normal, right? That's
Yes.
the common method, you know it. So
Yes.
amortization should start when the asset is available for use, ready for use. Just like for PP, I even gave you two examples, right? That you have two
Yes.
vehicles, one is being used, one is
Vehicles.
not. Yes, but we are depreciating both. So the same here. When it's ready for use, you amortize it, right?
Okay.
Okay, when do you stop
Yes.
amortization? It's also obvious. You cease amortization at the earlier of the date that the asset is classified as held for sale. I told you, you learn a standard called IFRS 5, non-current assets held for what? For sale. If you
For
classify something
sale.
as held for sale, it stops being a non-current asset, right? So you
Yes.
you
Yes.
obviously stop charging what? Depreciation and the date the asset is derecognized, so whatever comes earlier. This applies even for PPE because even if you have the PPE by 16, you classify something as held for sale, you also stop charging depreciation, right? Or if you
Yes.
sell it, you derecognize it from the books. See, that is obvious. It won't be in the books. So how can you charge depreciation or amortization while it's not in the books? It's also obvious, right?
Yes.
Yes. So that's what usually the case. For example, here they are telling you something which even for depreciation it applies. Amortization method used should reflect the pattern in which the asset's future economic benefits are what? Are consumed. Okay.
Consume.
Maybe the future economic benefits are going to be consumed the same way from year to year. Then we say, okay, so the amortization should also be the same. I should use straight line, right? Something
Okay.
like that, yes.
Yes.
So whatever
Okay.
just comes here, you see, they're also speaking on residual value. That's what I told you when you deal with this one, most of the things will be like you're doing the what? The revisions. They're speaking on residual value.
Yes.
Yes. Residual value of an intangible asset too with a finite useful life is assumed to be what? To be zero, of course. Even for
Zero.
PPE, as long as you have not been told, you will presume a figure of what? Of zero. Right?
Zero.
Yes, let's say unless a third party is committed to buying an intangible asset. Of course, if someone is committed, it means that we always know the residual value because at the end of its life, someone will come and buy it at a certain figure. So that will be the residual what? The residual value.
Residual value.
Yes, so that's just be the normal thing. Right. Now, this is what you
Okay.
need to know. For example, for tangible assets like land usually does not have any has an intangible has an indefinite what useful life, right?
Lives.
Yes, you can also have intangible assets with indefinite useful life. Anything with an indefinite useful life cannot be amortized or depreciated because if you say something has 10 years, if you say depreciate it means you will be taking part of it in the income statement for 10 years, after which it will vanish, right? But if something has an indefinite
Yes.
life, it means it has an amortization of zero. Or if it's depreciation, it has a depreciation of how much? Of zero, right?
0.
Yes. So that's why there are principles to follow. If you have an asset with an indefinite useful life, you should always check for impairment. You should always check whether it has been what? You should always check for the impairment. Because if you leave it as
Okay.
it is, you will find yourself doing nothing on it, leaving it year after year. And if you're not careful, it could even take 30 years while you're not doing anything on it to just look at it. That's why an
Okay.
intangible asset with an indefinite useful life should not be amortized. That is obvious because it has indefinite lifespan. But I-36 impairment of assets requires that such an asset is tested for impairment at least what? Annually. I think you have
Annually.
to get some point here, right? Let me give
Yes.
you, because if I don't explain this, it will be like you think you have understood, but actually you will not have understood. Impairment works this way, right? Impairment,
Yes.
when we did PPE, I told you that to know whether there is an impairment, we usually compare the carrying amount against the recoverable what? Recoverable amount, which the recoverable amount,
Amount.
we look at the value in use against the fair value less cost to sell. Now, when dealing with impairment, it's not like at the end of each year we just compute these figures. Computing these figures for recoverable value news and computing the value news and the fair value less cost, especially value news, it's not like it's a simple task. You have to resort your time and energy, right, and expertise, right.
Okay.
And so,
Okay.
to do all this to measure whether there's an impairment or not, we first check whether there are conditions for impairment. So until
Okay.
you have observed the conditions for impairment, it's when you do this, right? That's the
Okay.
reality. Let's say maybe you see that obviously the asset maybe the car maybe say you speak of the non-current assets now. Maybe the car maybe you speak of the tangible non-current assets. Maybe say the vehicle maybe it got an accident. Obviously maybe you have changed the use of the asset. The previous use it was earning you a lot of money, but now the income has been greatly reduced, right? So you say okay, these are the
Yes.
conditions for what? For impairment. But now, if you have an asset with indefinite useful life, you do not need to check the conditions for impairment to do this. You should be doing this obviously at least annually, even without even checking whether there are conditions or what or not. That's my
Or
main point
not.
now. Yes,
Okay.
yes, that's my main one. Main
Okay.
point. You do not check whether there are conditions. You just do it blindly.
Okay.
Yes, just to avoid the fact that
Okay.
since you're not amortizing it, that figure will just stay the same, and this could actually have a very bad picture to the stakeholders, and it could mislead their economic decisions.
Okay.
Yes, so going further, you say the useful life of an intangible asset that is not being amortized should be reviewed. The other thing now, apart from using A36 to test it for impairment annually, we also say that, okay, if something is an intangible, as an indefinite useful life, we don't expect that to stay forever. So you should always be reviewing. Is it still indefinite or it has changed? You see that?
Okay.
We just try to
Yes.
avoid overstating the assets. We apply the prudence concept, exercise of caution.
Okay.
Yes. So that we should also be checking.
Okay.
Yes. So reassessing the useful life of an intangible asset as finite rather than infinite. Maybe initially it was indefinite, but after reassessing, you have found that right now it's finite. If it is finite, it means you have to amortize it, right?
Okay.
Yes. And actually, it could also show you that okay, since it's finite right now, I'm going to amortize it. It's also an indicator that the asset may be what may be impaired and therefore should be tested for what for impairment. But the good thing
Impairment.
in they are all tested for impairment annually. Maybe if you can observe it, maybe midway in the year, you can say, okay, I've observed it now and I'm doing it now to get the impairment. Yes.
Okay.
Yes, I think we are done because here we speak of goodwill. We have spoken of goodwill a lot and we are going to speak it too much, right? On business combinations, yes. So goodwill,
Okay.
simply speaking, like we said, is you as the company, maybe you are going to buy the equity of a certain company. Maybe you're going to buy 80% of that company. Let's say that company
Yes.
has its equity, which we usually call net what? Net assets. Those net assets,
Fantastic.
all of them, it means maybe they are 100%. But let's say you as the company only want to buy 80%.
Person.
We usually call it purchase consideration. That's what you're going to purchase. It means that you are purchasing 80. It means the other 20 are owned by other people, which we usually call non-controlling interest. Expect to find this in consolidation. Non-controlling what? Interest. So
Interest.
since these net assets will be in full in the books, you take your 80%, you add what you do not own, that what is owned by other investors, right? You add them together, you
Okay.
add this one and this one, and you take the figure and you deduct the net what? Assets. What remains
Asset.
here is what we call what? Goodwill. Goodwill, right?
Will.
Yes,
Okay.
so that's all about all those explanations and what? But we'll actually see it and they will do it a lot and they'll even determine the impairment of goodwill, right? When we go
Oh,
further.
okay.
Yes. So all these definitions, I don't know separable what I want, we're going to see that. Uh, the goodwill actually may be because of the following. I told that goodwill has a lot of reasons, and actually it could even be maybe part of a form. It could even absorb maybe the brand or other things. As long as, like I told you, their five fair values cannot be what? Obtained. When you are doing
Obtain.
consolidation and you cannot get the fair value of, let's say, an internally generated brand, it would obviously be absorbed by what? By goodwill, right? So
Okay.
simply speaking, these could be examples of good. Let's say you have a good reputation for quality of service. Maybe you have a good technical
Yes.
expertise. Yes. Let's say you possess a favorable contract. People know that you have very good contracts and for a long time, so they trust that I will provide them with good service and reliable ones. Maybe you have the good management and staff. People trust your organization, right? In a variety of ways,
Okay.
in variety of people, maybe of contracts, something like that. And then purchase and unpurchased goodwill. We spoke about this already. I just put it like a summary, right? We said purchased goodwill is recognized in the what? In the books because it is paid for and it could be measured reliably. Non-purchased goodwill is an example of internally generated what? Goodwill, which I told you you cannot do
Yes.
what? Recognize.
Recognize.
Yes.
Yes.
And this one is a for three business combinations. That's what I showed you. That formula I showed you for getting goodwill, this one. You see this formula for getting goodwill. When we speak of IFRS 3, this is IFRS 3 itself now. IF what? If you are told about IFRS 3, we speak of business combination, it speaks of how to get what? Goodwill. In
A good
IFRS
will.
3, what we do is to get the good value of goodwill, this purchase consideration is taken at fair value, right? This net asset,
Okay.
which is the equity of the subsidiary you are going to purchase, is also taken at fair what? Value. This
Fair value.
non-controlling interest, actually, there are two ways. Taking the fair value, or there is another method called proportionate method, but you don't need to know it now. But simply speaking,
Okay.
computation of goodwill emphasizes the use of fair what? Values. So as to get
Fair value.
something more reliable and that is fair to both parties, the selling party and the acquiring what? Party. That's all about business what? Combination. This you see here, right?
Combination.
Yes.
Okay.
Now about this negative goodwill, I don't know you're going to see it. But by negative goodwill, you can come back here. By negative goodwill, presume that maybe after taking this plus this minus net assets, you get something negative here instead of positive. You know, if you get something positive, it means that there was an asset that you have actually acquired unknowingly, right? It wasn't in the books, but
Yes.
you have acquired something. But in case you have a negative figure here, and maybe we usually recompute to know whether it's fine or not. After saying it is fine, then we say that's a gain on bargain purchase. That we purchased something much worse than what we paid for, right? And that is called the negative goodwill
Okay.
is a gain, and that gain goes to the income what statement.
Statement.
Yes. So that's so. But actually, we have spoken a lot about that. But you are going to see that in the what? In the specific standard, you are going to see that in consolidation of financial statements. to the core,
Okay.
right? Here we just need to
Yes.
have the know-how of what to expect.